needle on the record.
Welcome to Wage Cucking with JMO.
All right, guys, welcome to yet another episode of Wage Cucking with JMO. Today, it's just me, JMO, here. I decided to do one alone because I haven't done one in a while. Didn't want to bother Blake or Andreas, so I decided to take to Twitter and field some of your questions and see if I could make a podcast out of it. So let's get started. I copy-pasted a list of the questions that got sent to me earlier today, and hopefully I'll be able to respond to a decent portion of them. Let's get started. All right, the first question is from Fadar Holes, aka Chronic Guy. You were talking about seeing new L1s as interesting projects. Which ones are you most interested in? That's a pretty good question. I'd say anything that differentiates itself from traditional Ethereum or EVM. So off the top of my head, the move-based chains, mostly Sui and Aptos. I was looking at Sui a little bit earlier. Unlike the other L1s or L2s that have gained like a bunch of adoption, I feel like that adoption is due to the whole points airdrop mania we have now, whereas like Sui seems to be naturally growing. Again, it's a newer blockchain. It's developed from the Move programming language, which is different than Solidity. Other than that, anything else in the Cosmos ecosystem, I'd say I'm interested in, specifically stuff like Celestia, Say, Injective. Anything else? I think when Monad comes out, that'll be pretty interesting. It's offering an EVM product with parallel computing, which in my opinion is one of the issues of the current Ethereum chain. And then I guess it's not really new, but I'm always interested to see what Near is doing. I feel like since the inception of Ethereum, they wanted to sort of finalize the chain as a sharded chain, and it appears that Near has achieved that, at least in some form. So to me, it's almost like an idealistic, like 2015 idealistic projection of what Ethereum could be in its like purest form. Other than that, these aren't really layer ones, but I'd say I'm really interested to see what happens with chains like Blast and Manta. They have been hyped quite a bit. They had like a point system where if you deposit liquidity, you could farm yield, but then also get an allocation to their token when it comes out. And then you see both these projects pretty much blow up overnight, where hundreds of millions of dollars of TVL get locked within these protocols. And when I say locked, I mean, if you deposit assets in these protocols, you can't withdraw until a pre-designated date. So a lot of the liquidity in the crypto space right now, I feel, is tied up in these, which this is a whole nother discussion. But I'm a little bit bearish when all this stuff gets unlocked, because I guess it depends on the price of these assets at the time. But a lot of people, when they join these hype cycles, they probably overinvest capital, or they put too much capital in, not realizing that like the lockup really means a lockup, and they won't have access to those assets. And then by like a month into like a 6-month lock, they realize that they want to use the assets for like this new shiny toy that looks better than like the previous toy or whatever. So I am very interested in seeing how those two things play out as well. All right, next question. We have one from Matt Berkey. Would like to hear your Berkey11 would like to hear your take on Phenom Poker app and Virtue Poker's attempt prior. I read the thread exchange between you both, and it would be better served for long form content over Twitter. Yeah, sounds good. This is going to be a bit long, so it's going to be like pretty poker related. So if you're a non-poker person, a little bit of this might go over your head. Phenom Poker app is a new app, or a new project that came out in like the last few days, at least publicly, that's attempting to build a blockchain poker product. Yeah, I have some major issues with like what they're doing and what the team's overall competence. After talking with a few of them, it's pretty clear to me that they're like fairly incompetent. They don't really understand the blockchain technology as a whole, but I can go over it pretty quickly. So the first thing they're saying is that they're going to use machine learning to combat real-time assistance and bots. Real-time assistance is essentially, for those who don't play poker, is instead of you playing a hand of poker, you have a computer or a bot simulating the situation for you, and then you manually input like the results. So essentially, you're getting assisted by a machine rather than playing yourself. It's a pretty big problem in a decent number of online poker sites right now. I can't really comment on this just because they don't really clarify exactly what they're doing to combat this. So they're just saying that they are going to combat it. So until I mean, I don't have a grasp of what exactly they're doing. However, I'd say that anyone that uses the term machine learning, I automatically think it's a red flag, especially in like poker, crypto, whatever. I feel like that term is like a blanket statement that's like heavily overused, and it's sort of like if you see that statement, you're like, wow, that this is advanced technology. When in reality, like I don't think of a previous instance where machine learning has solved any of these issues. So the second part of the question is Virtue Poker's attempt prior. So for those who don't know, Virtue Poker was a consensus-backed project. Consensus was, this is before Ethereum had like this huge landscape of venture capitalists. Consensus was basically the hub for Ethereum development or the development projects on Ethereum. And they had varying projects that they were funding. I believe they were funded directly by the Ethereum Foundation. I believe they call them spokes, actually. It was supposed to be like a wheel, and then they have like spokes. So one of the spokes was Virtue Poker. And I know quite a bit about this because I played quite a bit of poker at the time. Yeah, so I talked with the team. I realized that similar to this, they were a bit incompetent, and I explained to them why it wouldn't work. Long story short, like not everything should be on blockchain. And I think this is a good example. They're attempting to use Ethereum as a canvas for them to develop a poker site. Ethereum, like even in its form back then, where there was far less user adoption, wasn't the best place to have a poker site, just because you're dealing with like thousands and thousands of microtransactions. I don't really want to get into too many of the technical details, but it to me it just wasn't conducive to building a poker site, and the whole thing felt a bit forced. Like crypto's hot right now. We're going to build a poker site, but we're going to have it crypto related. We're going to have this token, but the token didn't much make sense. They had like a governance system using the token called, I believe it's called like the justice system, basically where you could use the tokens to police the tables, which I've never heard of any poker player having the capability just to police tables using a token, or how that would make any sense. Yeah, so this is like 2017, 2018. Fast forward to 2024. The project is essentially dead, just because basically everything I explained to them came true. It basically has no users. They ICO'd for I think like around like 25 or 30 million, which is like a lot of Ethereum at the time. And I don't know what happened to like the funds or the token itself, but I assume it's down like around like 80 or 90%, if not more. Yeah, so that's the whole spiel on Virtue Poker. Phenom Poker is doing things a little bit differently. The few things that they want to differentiate themselves with is they want to create a DAO. What a DAO is a decentralized autonomous organization. Basically, as a token holder in the DAO, you have a vote into governance, or anything that happens within the DAO. So, like in a traditional DAO, that the DAO has a purpose, and every member who owns a token is a participant into it and is allowed to vote for proposals proposed by members of the DAO. Traditionally, in like the Ethereum and crypto crowd, DAOs don't work, I want to say like 99% of the time. In fact, I can't really think of like an actual decentralized autonomous organization that that is still operational today that is as intended, meaning like there are DAOs that exist today, but all the votes are delegated. So like they sort of give the appearance of a DAO when in reality, like a majority of the votes are still controlled by a centralized agency. Um, the big issue I think with their DAO model is they're advertising it saying that that the site eventually will be owned by the players and the players will get to control the site, which is simply not true. That's never ever going to happen. So the way they're distributing the supply is 50% of the supply goes to people that play on the platform, and then these tokens will eventually have voting rights on the platform. However, 50%, that means the remaining 50% of the supply is controlled by insiders. So like the founders, the seed investors, and whoever onboarded early get that 50% of the supply. The problem here is that 50% is heavily concentrated while the remaining 50% is heavily distributed, meaning like even if you get a fair distribution of the other 50%, the 50% that is heavily concentrated is going to have a majority vote almost always. The other thing I take issue with is this model doesn't even make sense if it works. Like if you're gambling at like let's say like the Bellagio or at the Wynn or something like that, if you're one of like the biggest degenerate whales, it doesn't mean that you have any idea how to operate the like a Las Vegas casino, right? Just because you gamble a size or just because you gamble frequently, it doesn't give you any credentials as to how to operate a poker or gambling site. So I feel like this is the same way. If you play poker, like the skill set of playing poker is completely different than the skill set of like maintaining and operating an online poker site. In fact, I would say there's no overlap of either. And the fact that not only is this not going to work, but also even if it works, it'd be a disaster. I feel like that should be a red flag. The second thing they wanted to do, which or that they claim, but which I took a bit of offense to, was that they're basically claiming that because it's the funds are held on chain and you have to interact with the smart contract, it's much safer to operate than trusting a third party, what they call an offshore corporation holding their funds. And this is simply just not true. So as far as I understand, they're going to be launching on a layer two. So what a layer two is it's just like an extension of Ethereum, but it in itself has its own risks. So in order to play poker on this layer two, you have to acquire a stablecoin. I believe they're using USDT. You have to bridge it to the layer two. That's another attack vector for your funds. It just the issue with bridging is in theory, you're holding your funds, but in reality, you're just holding a placeholder token for your funds, where your funds are being traded back and forth on the layer two. And if you look at historically speaking, a majority of the biggest hacks in crypto are through bridges, either native or third party bridges. So that's another risk factor. The other thing that they're incorrect on is that the fact that smart contracts are somehow more trustworthy than offshore corporations, and I feel like people use this term a lot, offshore corporations, as that's something that's like negative, like you don't want to deposit your money in an offshore corporation; it's dangerous. I mean, like Binance is an offshore corporation, essentially, right? They're holding billions and billions of dollars of crypto, and they're probably like the most trusted place to exchange crypto. If someone new to crypto came to me and asked where should I trade, like Binance would be one of my first responses. I fully confident that Binance is solvent and running a legit operation despite being an offshore company. However, their model is essentially they'll have the game engine off chain, and then they'll have a smart contract for the settlement of the funds on chain. The issue with this is I guess like part of that is that they claim this is safer because you own the funds. You have self custody of the funds. Just because you have self custody of funds doesn't necessarily make it safer. In fact, I would say that a lot of the times individuals who don't understand how to operate crypto that are getting into like Web3 or crypto for the first time have a much more difficult time maintaining the security of their funds than if they just used a centralized like a centralized organization to store their funds. So in order to interact with any smart contract, which I had a discussion with them about this, and they did not seem to like fully understand this concept. But in order to interact with any smart contract, you need to set your, especially like in any EVM smart contract, you need to set your approvals first. What an approval means is you're giving a smart contract the right to use a certain number of assets in your wallet. So even if the custody of those assets are within your wallet, it doesn't necessarily make it safer because the smart contract can still interact with those funds. Um, yeah, so like moving forward, there's clearly at least a decent amount of risk there. So instead of trusting one offshore corporation, one body, you have to trust like a third party bridge. You have to trust like the stablecoin you're using. You have to trust your own secure setup for maintaining self custody. But you also have to trust stuff like the smart contract being non-buggy and unable to be exploited. You have to trust the API key risk because there's going to be a relay feed between the game itself and the smart contract, because that's the only way that they'll be able to move the results back and forth. So, for example, if you deposit $1,000 and you play poker and you win $1,000, how does the smart contract know to send you $2,000 if the game is entirely offline? Well, what happens is there's an API key that interacts and sends a message to the smart contract to send that. But that's just another layer of risk because, like in the crypto space, API key exploits happen quite a bit, even in the most secure setups. I know recently my friends at Kronos Ventures had like a really big issue with their Woo network positions because their API key got exploited, and knowing them, they had a pretty secure setup, and it still got exploited, and they still lost millions of dollars. Yeah, so moving on, I feel like I could rant about this quite a bit more, so I'll try to keep it concise. The token itself seems like a bit of a grift. Basically, they're claiming that it's a security, so we're not going to sell it, and there's going to be no market for it. But as far as I understand, it's like an ERC20, meaning it's transferable and meaning people will create markets for it. So the selling point is like, well, there's no market that the insiders can't dump on you because there's going to be a floor price and it'll be based on the revenue of the company. I mean, historically, that's just simply not true. If you issue a token that has some value on chain and you tell other people not to trade it, there's going to be a DEX market for it like within the first day. I don't understand how it doesn't make any sense to me, because if they were actually wanted to prevent the trading of their token, they wouldn't have a token in the first place. Like the entire point of an ERC20 token or any token on any EVM chain is to be traded back and forth. So like conceptually speaking, the whole crypto angle of the project, it doesn't make much sense to me. Other than that, like I had a few interactions with the team. I'll talk about I'll talk about one more thing. Let me pull up this tweet. So I think it's the founder. His name is Matt. He said, "It's up to you who you'd rather trust, but if you don't trust code over offshore companies, then maybe stay away from crypto." That, by the way, is like the dumbest thing I've ever read by someone. Why not give people a choice? For those who want instant settlement and comfortable using self custody in a wallet to deposit funds into a smart contract, Phenom might be a good option. Okay, so this just shows like a fundamental lack of understanding of anything. So first of all, just because something is in a smart contract or something is in code doesn't mean you should blindly trust it. And in fact, a majority of the time you shouldn't blindly trust it because there's malicious code everywhere. The problem is like individuals like me who are, Solidity devs, we can't just read code and figure out, well, what code is malicious and what code is not. That's why we rely on third party companies like Certec that audit these codes and tell people that it's safe or not. The other thing is that offshore companies are the driving blood behind crypto. I mean, before like Ethereum automated market maker dexes even existed, like BitMEX, Bitfinex, Poloniex, Binance were the hubs of crypto. Like crypto would not exist without these offshore corporations. So this is just like sort of a idealistic view from someone who's probably not into crypto, doesn't understand crypto, and is trying to portray like a holistic view of you should always trust the code. But like for the people that are actually in crypto, that understand crypto, blindly trusting code just because it's on chain, just because it's decentralized, just because it's within a smart contract framework, is one of the dumbest things you can possibly do. So I guess in conclusion, I don't really know enough about what they're doing to make a solid judgment on how they're going to do. However, just by like these interactions with them and like the way that they're explaining certain principles of what they're doing, it to me, it just shows an extreme lack of understanding of both cryptocurrency, of both how like Solidity and EVM chains work, and the overall the overall issues and the overall risks that them and their users will occur. So to me, I feel like that they're just a bit incompetent, and it's fairly unlikely for them to succeed. Next question. Sorry about that. That was a long rant, but yeah, I've been going back and forth with these guys for a few days. So I definitely have. I have a ton more thoughts on it, but I don't want to hold everyone up here. All right. Next question. Establish the Fund says, for the little guys, what would you do with 50,000 in stables right now with a goal to 3 to 4x in a 1 to 2 year timeline? My rough plan right now is 40% BTC, 40% SOL, 20% speculative stuff, with plans of selling at 80k BTC and selling SOL at 3 to 400. I'd say the first thing is, if you have $50,000 right now and you don't have any crypto experience, a goal of 3 to 400% return in a 1 to 2 year span is pretty unrealistic. So I'd start off there by not thinking that. The rough plan of 40% BTC, 40% SOL, and 20% more speculative stuff. I'd say I don't know what the speculative stuff is, but BTC is still pretty speculative. SOL is still pretty speculative. Yeah, I guess it's within your risk appetite. Like, I'm not going to tell you to like buy this bag or buy that bag, but overall, the expectation that all assets are going to go up, and you're going to like forex your money within like a few years is unrealistic. So I'd start there and not have that mindset. Next question, Mr. Manikai. Just looking for general commentary on ETH BTC rotation. Many traders have rotated from BTC into ETH around the ETF approval / launch. Curious to hear you. Good trade, bad trade. How would you time it, and other considerations? I don't think that's particularly true. Like I don't think there was much of a capital rotation in from ETH to BTC around the ETF approval. In fact, like the ETH BTC ratios have been declining quite a bit in like mid to late 2023, and actually had a decent upswing. I want to say like within the last like 2 to 3 weeks. Yeah, like the whole Bitcoin ETF thing, I think is pretty interesting. Obviously, it hasn't gone super great so far, just because the whole Grayscale scale GBTC situation. I guess most people realize that GBTC was holding quite a bit of Bitcoin that was essentially locked for all its users for quite some time. And those positions slowly needed to unwind. And what unwinding means in those positions for a lot of people is taking the Bitcoin out and then selling it for fiat. So I feel like that's sort of playing out right now. Um, I think I talked about this. I did a podcast like a week ago, where we talked about like the future of Ethereum, and I think the biggest issue with Ethereum is that it's not really competing with Bitcoin right now for the whole store of value institutional money coming in, and it's not really competing with the layer ones to be like a smart contract platform that's like the best and most efficient. So it's in a sort of like middle ground where it's trying to find its identity. I think a bull case for Ethereum is possibly an Ethereum ETF coupled with a explosion in the ecosystems of a bunch of layer twos. So not only stuff like Optimism, Arbitrum, but also stuff that possibly can come out. Like I talked a little bit about it earlier, but like if something like Blast takes off, or something like Coinbase's Base takes off, or something like Mantle takes off, or if Starknet or ZK Sync starts blowing up, that drives a lot of value to Ethereum. So, yeah. So next question. This is from at I'm here for the tech. A great screen name. Do you market neutral trades like long one asset or short another? I assume he's asking if I basis trade, and yes. So essentially, what basis trading is, and I think it's like in times of volatility or in times of high volume. I feel like basis trading is like one of the easiest ways to make money in poker. Or sorry, I have poker on my mind. Money in crypto. Basically, what it is you either long or short one side. So you have a perpetual contract for a token, and then you have like the spot markets for the token. So depending on the funding rates for the perpetual contract, you can either buy spot, short the perpetual, or sell spot and then long the perpetual. But basically, because you're taking both sides of the trade, you're creating a market neutral position, which means like your dollar cost average, or like the amount of money in dollars you put in for your capital, will almost always stay the same, and then you're just capturing the difference between the funding rates within the markets. And I think it's one of the best ways to, if you're like not a good trader, if you're not a good trader in terms of buying or selling directionally, it's one of those things that doesn't take much intuition or anything. It's a purely mathematical thing. You can look at the funding rates, you can look at like your exact return, and then you can allocate your positions based on what you think your return will be based on the numbers. So yeah, I do that, and I think it's like one of the first things people that want to get into crypto, that want to make safe trades, should do. All right, next question. In Idiocracy, asked a bunch of questions actually. Opinion on MATIC, 2, opinion on DOGE, 3, what to rotate ETH to after EigenLayer airdrop, and 4, ETH L2s versus Sol with EIP 4844 on the horizon. Opinion on MATIC. I think MATIC is pretty interesting. It was almost like a meme chain for a while. Just by like the tech and how it worked and what was on it. But I think recently they've been really pushing the technology to make it like a fairly technically advanced chain. I think the limitations are it's still like an EVM chain. If the future is like non EVM parallel computing with like these new high throughput like advanced technology L1s, it's not going to compete in that space. But if the future is EVM, then I feel like they have a good shot of capturing a decent portion of the market share. Second question, opinion on Doge. I think Doge is one of those coins that like is always going to be around. It's sort of like the Bitcoin of meme coins. Like meme coins come and go, but Doge being like the original one is like the first mover, if you want to call it, advantage in the meme economy will always have weight to a point where there's always going to be community people within Doge. I think the distribution is pretty good considering like the founder just barely distributed. I don't think he holds like much, and if he does, he exited a majority of his position like far before the whole meme craze took off. So it has like the ideal traits to be like the legacy meme coin in the crypto space. I don't necessarily know what that means for short term um, for short term price action. I think like right now, if anything, it's probably like a little bit undervalued with stuff like I mean like the nonsense that's going on in Solana with like Bonk and Dog with Hat and stuff like that. I feel like those are likely to sort of die down like within you know by the end of the year at the latest. Whereas I think Doge has pretty long term lasting power as long as like Bitcoin, cryptocurrency, stuff like that has mainstream adoption. Three, what to rotate ETH to after EigenLayer airdrop? Yeah, I'm not going to tell you what to buy or sell. I will say though that one of the concerns I have, and this is not necessarily specifically with EigenLayer, but it's with all these protocols that have like these point systems that require you to lock up a substantial amount of your Ethereum. I guess it depends on the price of Ethereum at the time of unlock. But let's say Ethereum, like short term, has a bull run and goes up to upwards of 3,000, which is like very optimistic and unlikely, I think. But it's possible. Then you have like a bunch of people that have you know dollar cost average entered Ethereum at like a much lower price point that have been looking to sell, but their assets are staked on chain and locked, therefore they're unable to sell. At the point where everyone is getting their assets unlocked around the same time, I think like the obvious 100 IQ thing is like, well, there's going to be a rotation into something, which I don't know if that's necessarily the case. Um, it's possible that if people will take profit. However, taking profit doesn't necessarily mean rotating into other assets. It could just be selling back to the US dollar, or selling back to Bitcoin, or even just taking their Ethereum out of something like EigenLayer and then just like restaking it on Lido, or like putting it in an uncentralized exchange and using it as liquidity. So yeah, it's like I think it's questionable whether you should rotate into anything at all after these airdrops play out. And the fourth question, Ethereum L2s versus Solana with 4844 on the horizon. Um, yeah, I'm not exactly sure how to respond to this. In theory, 4844 is going to improve Ethereum quite a bit, which will also, in fact, because it improves Ethereum, it'll improve the layer two experience. Just because like the base layer will process transactions better, cheaper, faster, have higher throughput, whatever. I'm not sure if that's really enough, and I'm not sure if that really matters. Uh, Again, I've always had this thesis that the best technology doesn't necessarily always win, and a lot of competing technologies are very, very close in what they do. So if if Ethereum improves by like a quantifiable, let's say 50%, it doesn't mean that they gain 50% more market share, or the price goes up 50%, or like 50% of the users from Solana decide to move to Ethereum layer twos. So it's very difficult for me to equate these technical benchmarks that these chains hit with stuff like price or adoption or users and stuff like that. So yeah, I can't really answer. I'm not sure. Although I'd say, like at the point where that happens, it will likely be bullish for Ethereum, but it's a little bit unseen right now. All right. Arpit TIW say, what crypto products do you think we need in the market today that you haven't seen people working on? Yeah, that's a good question. One of the things I'd like to see is a whole different level of interconnectedness between like all the central entities that offer centralized exchanges and stuff like that, and then everything offered on chain, whether it's like dexes, decentralized finance, borrow lend platforms, stuff like that. The simplest example is if I'm a big Binance trader. I trade the Binance spot markets. I trade the perpetuals, but then I also do a decent amount of, let's say, decentralized yield farming on chain. I think something that would be interesting is, because the positions on chain, the capital is being used for farming purposes. It can't be used as collateral. But there are platforms on chain that allow you to use your LP positions as collateral. And I'd like to see something that sort of connects the ability to LP to provide liquidity on chain with the ability to use that same liquidity to be used as collateral to, say, trading perp markets, or trading spot markets, or trading future markets, because it just allows everyone to be like more capital efficient. Like imagine if you could be, farming your EigenLayer airdrop with Ethereum that's deposited on, say, something like Frax or Mantle ETH or Lido, but then also use that even though it's locked. Just because it's locked doesn't necessarily mean it means it's worthless. If it's locked within a certain position, you can hand over that position to, say, like a centralized exchange such as Binance, and they'll allow you to use that position as collateral, so you won't have to deposit as much in other assets. Other than that, I'd say the interconnectedness of blockchains themselves. I know this is like sort of being developed right now, but it's not really being developed in a way to my liking. So, like the first thing is that I think bridging is a disaster right now. There isn't an industry standard for bridging. But back to my whole Phenom Poker rant, where they want to bridge assets from ETH to an L2, and then they're trying to claim it's safer than a centralized entity. Yeah, there isn't really a standard for bridging right now. There isn't really a standard for communication with blockchains. I know my friends at Layer Zero are trying to build that for the future, but there isn't that much besides, let's say, like Stargate that allows bridging using the Layer Zero standard. And a lot of the bridges, like right now, are third-party companies that are fragmented. A lot of the bridges are centralized, that they have like a single point of failure. You look at what happened to multi-chain. You look at what happened to Wormhole. Like the only reason that like the 300 or 400 million whatever assets that were exploited from Wormhole didn't bankrupt everyone is Jump Capital plugged the hole immediately because they believed in the project, which, shout out to centralized entities like Jump Capital. But yeah, I'd like to see like more of an industry standard for how chains communicate with each other. So in the future, the whole crypto landscape, if it's like going to be like this robust multi-chain ecosystem, the people from one chain don't have to be so aligned with that chain that they can interact with like all chains while predominantly focusing on the chain they like the most. Next question. Free Shkreli, please. I think he's free already, isn't he? Will there be yield on ETH ETFs? I have no clue. There should be, just because it's free money and it adds to the selling point of ETFs. So, like for those who don't know, there's going to be a Bitcoin ETF, and if the proposed ETFs pass in the future, there potentially will be an Ethereum ETF. The way the Bitcoin ETF works, as far as I understand it, is they just like hold Bitcoin in cold storage, and it doesn't see any yield. However, ETH within its protocol has a staking system to secure the network. It's completely proof of stake. So the ETH that is dormant, meaning not being staked and not being used for other purposes besides staking, is essentially wasted yield. There's free money to use your Ethereum to secure the network. So if I think it'd be awesome if you could invest into a staked ETH ETF over an ETH ETF, because like the selling point is like you don't need the technical knowledge to run up your own validator. You don't need the 32 Ethereum. You don't need to trust a third party like on chain. You can trust like a centralized entity that's like FDIC insured or whatever to handle your Ethereum and create the staking contract for you. The Ethereum never leaves your brokerage account. It never leaves your IRA. It just grows and grows and grows. I think that's a huge selling point, and I would absolutely 100% love to see that happen if an ETF does get approved. I'd say if there are competing ETFs and there's only one that figures out like we should start staking our ETH, I feel like that one will gain a majority of the market share just because it'll outperform the other ones. So eventually, I think it will happen just because of that. But then again, I don't know about like the legal or technical hurdles for like an exchange traded fund to stake any asset or to move any asset into staking that they hold. But yeah, it would be awesome for sure. Next question. GG Vault 1. Why do you think Mantle is the winner in the L2 wars? I don't necessarily think Mantle is the winner. I'm going to be a bit biased because I'm close with like a lot of people that are building on Mantle, and I like their overall direction. But I don't think that the L2 wars, if you want to call them wars, are going to be a winner take all situation. However, I do think it's going to be a winners take most situation where like now there's probably like 20 or 30 or 40 L2s. Did I say L1s earlier? Sorry, he asked about the L2 wars, but there are probably like 20 or 30 or 40 L2s that are being used. I feel like those will be consolidated into maybe like, I don't know, like 6 or 7 that gain like 90% of the market share, and the other ones sort of fall off. What I think Mantle is doing well, they spun up their own LST that I think it launched mid-December, and it's already like the fourth or fifth biggest LST. They have a good team working on building out the on-chain products. Shout out to Jordy, previous podcast guest. They're doing a good job building out like decentralized finance on chain. A few things I like in what they're doing is they're not paying. So the Mantle has quite a big treasury. It's probably like the biggest on chain treasury for an L2 right now. But they're just not punting money left and right, incentivizing, let's say, like the big players like Aave, Compound, Curve, whatever, to build on their chain just for like the brand and the name recognition. But they're actually developing native products. And if a team that they like wants to build a product on Mantle, they're not importing the legacy token and the baggage of the token with it. A good example is Merchant Mo, that is a DEX that recently launched on Mantle. It is, I believe, like mostly the same team as Trader Joe, which is on AVAX and Arbitrum right now. That they do a fantastic job. They're very competitive with Uniswap and the whole automated market maker DEX concentrated liquidity type DEX market. but instead of importing like the brand name of Trader Joe, of importing like the token, of bridging the token open, or bridging the token over, they are building out their own exchange, having their own native token, and building their own ecosystem around specifically that exchange and specifically for Mantle. So I think they're doing really good things. They're on the right track. Their growth from not immediately existing until mid last year to growing, and not only their LST but their whole DeFi suite, and yeah, not much else to say about it besides like I think they're on the right track, and if there's, let's say, like 6 or 7 winners in the L2 space, I think Mantle will definitely be one of them. All right, next question. The Nauts God One says, your thoughts, please, on the current supply overhang narrative for corn. I assume that means Bitcoin, even though he used the corn emoji. Yeah, I think there's a lot of supply overhang. I think it's very real. I think right now we're sort of seeing it play out with the whole GBTC unwinding. I think people didn't realize that exactly what GBTC was and how much overhang it is. So essentially, GBTC, it was Grayscale's Bitcoin investment, a pseudo ETF, because it's a one-way street. Basically, for the longest time, you could only deposit Bitcoin, but you couldn't withdraw Bitcoin. So like the fund the fund asset value always went up because people constantly were depositing Bitcoin, but like there were no outflows, and that's a big reason why for quite some time the GBTC price traded under its native asset value, is because people were looking for exit liquidity, so they're willing to pay a steep discount in order to sell their GBTC, even though the underlying assets are worth far more. And now that like these ETFs are approved and the whole thing is unwinding, the reason that the outflows of GBTC are so high is not only because of that, but because they offer a far less competitive fee structure. I think that their fees are like 4 to 5 times like the BlackRock ETF. So it's questionable whether all those outflows are people just like selling in the spot markets in order to exit back to USD or any form of fiat, or if it's people that are just rotating into like a different ETF. However, like the ETF inflows haven't been that huge, while the outflows of GBTC have like increased on a pretty heavy basis in the last I'll say like in the last week. A few other supply overhang events for Bitcoin. I think the biggest one would be the Mt. Gox situation. I think it's like 150,000 Bitcoin that are going to hit the market at some time, or at least be unlocked at some time. I think to note about that is that's going to be an even worse one for Bitcoin, because the average person who like entered Bitcoin and has a Mt. Gox balance entered it at like somewhere between like $100 and $500 per Bitcoin, whereas like GBTC, they probably entered somewhere between like $3,000 and $20,000 for Bitcoin. So like the average cost of Bitcoin for those entrants is completely different, to a point where it makes far more sense for like your 2011 to 2013 first cycle of Bitcoiners to want to take profit on their coins that have been locked for 10 years versus like your 2016 to 2018, and entries that got into GBTC through their Merrill or their like Vanguard account. I think it's two different crowds of people. And if that unlock happens, I think it's going to be a decent amount worse for Bitcoin. At least the sell pressure is going to be a decent amount worse Bitcoin than we're seeing now with Grayscale. The other one I see is, I think this is only going to be an issue if the price of Bitcoin goes up like substantially, but it's Michael Saylor and his MicroStrategy position. Basically, he's borrowing or leveraging his company, the value of his company, in order to leverage his Bitcoin position. I think this will be less of a stress, just because I don't think he exits very frequently, and when he does, it would have to be like at a super high price point where it would be like basically terrible for his investors not to take some profit, given the overall risk of what he's doing, essentially leveraging his company and leveraging debt in order to have a levered long on like a single asset in Bitcoin. So that one's a little bit less concerning for me, just because if that starts to unwind, I feel like it means like the price is near or above all-time highs already, so that wouldn't be much of a concern for me. I'll do one more. Sharpie Junkie 88. What is your long-term thesis on Bitcoin? I think the long-term thesis is for me, it's just like the first mover in the digital store of value space. The long term value is that the Bitcoin inflation curve is designed in a way where every halving, there's less and less Bitcoin being released. So in theory, it's inflationary, but the inflation is decreasing, and over time, and not only that, like Bitcoin are lost or Bitcoin are spent or whatever, there's going to be a wider and wider distribution of Bitcoin. I think the way that the supply is designed makes it like very ideal to be a store of value. Like if you look at the current trend in like the new L1 space, it's basically you have like a certain set supply and you only release like a small percentage of it. So like the circulating supply might be like 5% of the fully diluted valuation. But so if you look at like the market caps of things, and if you're just looking at the circulating supply, what people can hold, what people can trade, you may look at the number and think that's like fairly reasonable. Whereas there's just like all these pending overhang unlocks that are going to come out. I think Sam, the notorious Sam Bankman-Fried, is one of the worst violators of this with like his designed Sam coins. So stuff like Serum and Oxy and Maps and a few others. It basically where like a certain percentage of the supply was distributed initially, but then like a lot of it was sold like OTC or sold to investors with like these absurd vesting cliffs, and knowing full well that like by design the value of these tokens would go down over time as the supply gets unlocked over time. So I think that model is not great for long-term store of value. I think the Bitcoin model of like a certain block reward based on like a finite number of Bitcoin that halves indefinitely, so that there's always going to be like in theory that there's always going to be Bitcoin left to mine, because you can just keep having and having and having. But then it also sort of curbs the long-term inflation, so that there's a point where like in the indefinite future, you can say that this is like the supply cap of Bitcoin. And that's like fairly appealing to investors that are looking at the tokenomics of something and considering whether it's a good store of value or not. So that's my long-term thesis for Bitcoin. I think it always helps that like now we have an ETF and now it's easier to acquire Bitcoin, and then soon like the whole self-custody thing will be easier. I mean, like in 2013 to 2016, like we barely had hardware wallets. You basically had to store your money on like a seed phrase on like on your computer and hope your computer didn't go down, or hope you could back it up correctly. We didn't have like these centralized institutions like Fireblocks that handle custody. We didn't have a lot of things. So I think as Bitcoin progresses, as more people start using Bitcoin, it'll become easier and easier for individuals to, store, acquire, hold Bitcoin, the whole technical hurdle to enter Bitcoin is going to go down by the day, and that just increases adoption for Bitcoin, because like now previously people that like maybe heard about Bitcoin in 2017 but like did not want to figure out a self-custody solution, or didn't trust themselves to figure out a self-custody solution in order to store Bitcoin, will have a much easier time in say like 5 to 10 years, because there's going to be constantly new solutions and new innovations coming out in the space. I think that's it. Did about an hour. Yeah, I just wanted to get a podcast answering some questions. Hopefully we'll have some guests on in the future ones. I hope you enjoyed this. If you like this format, maybe I'll do more of these in the future.